for the economic impact. Let's bring in Michael Strain, the Director of Economic Policy Studies at the American Enterprise Institute. Michael, 4 million, that's a lot of work days lost. What does it mean for the broader economy?
It's a lot of work days, and it's a consequence of the fact that employers have a voracious demand for workers. Labor demand is off the charts, and there just aren't enough workers to satisfy that demand. And so workers are in the driver's seat to a larger extent than they have been in decades. They're demanding more from their employers. They're demanding higher pay. They're demanding more workplace amenities. They're demanding more control over the structure of their jobs. And as labor demand starts to cool off, those dynamics are going to reset a little bit, and we're seeing that kind of volatility in the relationship between workers and employers.
Michael, I want more pay and less work hours in a day and better benefits as well. Do I have the leverage right now? What is it about these industrial companies, specifically autos, that makes you feel as though they may or may not get what they want from GM, Stellantis, and Ford?
Yeah, so I think we're seeing this throughout the labor market. The statistic that I would focus on is average wage growth. Wage growth for the average worker. Before the pandemic, in the kind of great economy of 2018 and 2019, wages were growing at around a 3% pace. After the pandemic, when employers needed workers and there just weren't the workers there, wage growth went up to about 5%. Now we're kind of back into 4%. So the labor market is cooling off, but it's still much hotter. And workers are still in the driver's seat much more than they even were in 2018 or 2019. This is emboldening the labor movement. This is emboldening labor organizers and labor unions. And what you're seeing in this specific instance is the UAW asking for some pretty unreasonable demands. A 40% increase in pay, 20% shorter work week, return to some old economy types of workplace amenities. I don't know that the auto companies could give them what they want without going bankrupt.
Well, Michael, so let's talk about then the Walmarts of the world. I kind of feel like, when I think about minimum wage and I think about restaurant jobs and I think about what Walmart, first of all, is the ultimate strike buster. In other words, they can dictate price. And when they were pushing up wages for their workers, it was a great thing for our country when you think about the middle class needing to make a working wage. But isn't that a lot more important in terms of the inflationary forces in the labor market? Because that's where you've seen the biggest surge, and frankly, maybe where we deserved it, as opposed to the unions.
Yeah, look, if everybody in the economy got a 40% raise, which is what the UAW wants for their workers, that would be hugely inflationary. If you look at the services sector of the economy that you're describing, there you're seeing even faster wage growth. The wage growth that we've seen since the pandemic has disproportionately accrued to those lower wage workers. And so the low wage services sector has seen faster wage growth than the average, even though the average has seen much faster wage growth than prior to the pandemic. And that's the segment of the economy I think that the Fed is most concerned about. We've seen the price of goods, inflation for in the goods market, totally under control, even deflationary in some months. Inflation in kind of the higher wage services sector of the economy is relatively under control in the labor market. It's that low wage services sector where wages are still really hot, and where the relationship between wage inflation and price inflation is the strongest that the Fed is focusing on, I think, appropriately.